Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and with me is Mangalam, and the market's a little bit off color. But we've got a couple of, IPOs that listed today. HDB Financial made its debut on the Dalal Street today, listing at a premium of around 13% to its issue price. To discuss the company's plans, the outlook, we're joined by Mr. G. Ramesh, the MD and the CEO of HDB Financial. Hi, sir. Good morning. Congratulations. A big event, a lot of hard work gone in there. And, those that got the share in the IPO, they'll be happy because the stock is listed at a sharp premium. That said, this time around now, you can give us some kind of an outlook. So what kind of a growth, AUM growth are you looking at for this year? If you could help us out with that. And what kind of rough NIMs should we work with? Please go ahead, sir.
So thank you first of all for inviting me to your studio. It's a day for our listing. Thank you very much for inviting me. As you know, this is the largest NBFC IPO in the history of India, 12,500 crores. We also have the largest applications for $1 billion plus IPO in the last 4 years. So first of all, thank you to all the people and all the investors who have shown active interest in our stock. We had over 22 lakh retail applications, so thank you very, very much. Now, in terms of our growth, we are a 17-year-old company, been through cycles. We understand the cycles and we understand India. And our whole focus has been on targeting aspirational India through our products and services. In the last 3 years, we grew at a CAGR of about 20%. And I think that's a number that we are quite comfortable with.
All right, 20% and HDFC go hand in hand, and HDB Financials, we don't expect any different for them as well. But, I'd like for you to throw some color on what would lead this growth, because I'm looking at your book. About 40% is enterprise, about 37% is asset-backed, and consumer finance, which a lot of people are eyeing, is just about 20 to 23% of your book. So going forward, what is the ideal mix that you would have, and which of these will outperform?
We are a customer company, not a product company. We have had a long journey of introducing new products, and it's part of our DNA. We launched enterprise lending in 2008, and we launched asset finance in 2011, consumer finance in 2016. So consumer finance is our newest business. It was about 13% about 5 years ago. It's 23%. We believe that all our businesses that we are in have an opportunity for growth as India grows over the next few years and decades. And what we're really trying to do is to make sure that we have adequate capital allocation in all the aspects of our customer, whether it's the business or personal needs, and that's how we think about growth.
What, according to you, would be the ideal mix? Would it be one-third, one-third, one-third?
So we don't have really a target. I mean, so what we would like to have is a very diversified book so that we can manage business cycles. So there'll be businesses that have a certain low and a business that have an opportunity. So what we're really trying to do is to have a well-balanced portfolio. Don't have a target in terms of mix, but in terms of opportunity, I think a one-third mix would really make sense.
All right. And, borrowing from banks, I think, is approximately a third of your total borrowing mix?
That's right.
All right. And, we have a couple of rate cuts that have come about. How does that tie into things? And what should the rough margin band we should work with?
So, a rate cut cycle is obviously beneficial for a company like ours. About 70% of our book, more than 70% of our book is on fixed rate, given that the customers that we work with and our retail book, as you may know, our top 20 borrowers is less than 0.34% of our AUM. So that's the level of granularity. So a lot of small borrowers that we lend to are extremely comfortable with a fixed rate asset scenario. And then, so that's what we work with. And a rate cut cycle obviously benefits both the lender and the customer. So that's something that we look forward to as a company. Historically, our gross NIMs have been in the region of 7.6 to 8%, depending on the cycles. And again, our focus is on diversifying our product, and within the products are micro segments so that we can deliver a reasonable risk-adjusted return.
And this band that you've been speaking about historically is likely to continue irrespective of what the cycles are?
That's right.
Perfect. What about your return on assets? I'm looking at your return on assets. So the last few years, 3 years in particular, they've been contained between 2 to 3%, while the same for your peers have been a lot higher. What is your plan to increase or improve your return on assets, sweat your assets a little better from here on?
So our plan to improve that would primarily focus on the product portfolio that we work with, the customers that we work with, and within the customer segment that we work with, the product customer segments that we can work with so that we can generate a reasonable risk-adjusted return. That will be our strategy.
And would you have a target on how much you would like to improve this to, any sort of band that you're targeting from here on?
So our focus is on making sure that we deliver a good stakeholder value over a long period of time. Our fundamentals are very strong. We have a strong business model. Many of the businesses that we are in, we have a large market share in terms of how much we originate on a monthly basis. And that's something that we'll continue to work with.
All right, a word on asset quality then. There is that fear that keeps creeping up, that things are slowing down, maybe people are borrowing a little too much, punching over their weight. What are your observations, sir, in terms of customer behavior? And any worries, or you think, whatever we are seeing are just knee-jerk and it's par for the course?
So we are in the business of risk management, and it's a fundamental business that we do is manage risks. As I said, 17-year-old company manage risks through cycles. We're very conscious of how we manage our risk and our cycles. So it's something that we have done over the years and quite confident of continuing to do so.
How would you maintain your yields from here on? Because I'm looking at your secured and unsecured mix. Secured is close to around 71%, unsecured about 29%. Where do you see this mix going, and how would that impact your yields?
So again, our yield is really a function of the product mix that we generate. And the way we think about our products is that we will typically have a annual tactical plan for capital allocation for each of the businesses we are in. So every business that we have will have a certain amount of cycles. And we make sure that we are allocating capital to the businesses that we think are the best from a risk-adjusted return perspective for this year. And that's how we allocate capital. In terms of our March 31st number, our secured was about 73% of the book, and unsecured was 27% of the book. It changed marginally from the prior year, again, primarily because we focused our business on businesses that we believe have a better asset cycle at that point of time.
So as of what we speak, for this year's annual tactical plan, what is your capital allocation veered more towards?
So we'll broadly be, as I said, about 75% to 70% secured, and 25 to 30% unsecured. So that principle will broadly stay.
All right, take that point for now. Congratulations on a listing once again, and wish you good luck. Hope to speak to you every quarter, and perhaps hope to speak to you at a time when you consistently grow over 20% as well, with your NIMs in that 7.4 to 8% band, and the asset mix changing as per the asset cycle that you deem is fit, which improves your return on capital employed from here on as well. With that, we'll shift into our